So, let me try to explain to you why I think it's so hard to crash the Chinese economy today, even though every single Tom, Dick and Harry out there would like you to believe otherwise. My name is Chi Keng and I'll be channeling my inner Larry today. If you don't wish to sit through the entire video, I can give you the answer right now. It's basically two words. It's manipulated. I don't understand what is so hard to comprehend. Everyone loves to point finger at China, blaming Xi for literally everything under the sun. China is not fair in trade practices, China manipulates their currency, China is a dictatorship, China wants full control. In good times, China seems like they're in full control. In bad times, China don't even have enough to feed themselves, right? Let us at least be slightly coherent with our arguments. And I reside in the former camp. I'm inclined to believe that what is happening is largely controlled and manipulated. And yes, even the housing crisis. So before I start, remember to smash the like button to boost my ego, and also because I spent quite a lot of time scripting this entire video. So in return, to thank you, I'll be showing you a picture of me and Bei. With that, let's get right into it. Let me first show you the trend of the capital movements in and out of China. So this trend line actually shows the overall movement of China's hot money all the way from year 2000. So essentially, hot money represents the pool of funds that are constantly looking for the highest available short-term interest rate. So to me, they are essentially just cash for short-term speculation. Hot money, however, is considered extremely important in the international capital flow market because they tend to disrupt macroeconomic stability. Why, you might ask? Essentially, it's just the sheer volume and impact this boatload of cash-rich people can make or break economies and financial system, especially if it's not well developed like China. Don't forget, not too long ago, even hedge fund personalities like George Soros can break the Bank of England in 1992 and not long after destroy the Thai baht and Malaysian ringgit right before the Asian financial crisis. So the collapse of all these financial systems exposes the fragile nature of this entire discussion. Now, if you were to take a closer look at the recorded net capital flow of China, it is quite evident that it has been on a downtrend since 2014. The main driver for this outflow was largely due to the weakening renminbi and the Chinese market turbulence. Even though it seems like there is some sort of recovery in 2017, evidence do show a negative net error and omission account, which likely reflects unrecorded outflows, and the estimated capital flow will probably paint a better picture, which still illustrates that China is ultimately experiencing a net capital outflow quarter after quarter. So the funniest thing is, China is one of the most notorious countries to institute a multitude of capital restriction policies, including, firstly, individuals cannot spend up to US $50,000 per year on foreign currencies for travel, overseas studies, or work. Number two, Chinese individuals cannot directly invest in overseas stocks and bonds unless they are through banks or qualified institutional investors. Number three, citizens are also banned from exchanging the yuan to buy properties overseas. And notwithstanding Chinese citizens, on a company level, they would also need the government's approval for outbound investments of more than $1 billion outside of their core businesses of the Chinese buyer. Number two, extra large outbound investments valued at $10 billion or more. Number three, outbound real property acquisition with investment values of $1 billion or above. So, the said restrictions might actually sound extremely ridiculous, especially to foreign investors who champion rights, ownerships, property, and I can totally understand that. But if you were to actually think about it, I think you can empathize why the Chinese government is doing what they have been doing. I think the arguments discussing about how China wanting complete control of all your assets because they're greedy, because they're communists, are kind of totally off tangent. If they really want to monopolize all your assets, they don't even have to give it out to you in the first place. Why risk all this money being transferred out legally or even illegally by the people when they can just hold onto it on the government's balance sheet? Also, if that was the intention of the government, I think they would be quite stupid in spending so much time and effort to improve their overall system. To me, the focus is really on protecting and safeguarding their financial system from manipulation. You can't allow foreign forces to manipulate if you are the one manipulating. Big brains. Now, what do you think is the most important thing in a financial system? Money, duh. But it's the flow of money that is important. The flow. So the interesting development that China is currently undergoing is the constant echoing of China is intending or at least discussing to loosen their capital control policies and allow for a more fluid market. You can see that there are tons of headlines and speculation surrounding this entire topic. But don't forget, China has always promised to look into loosening their policies, but have always held back. So, what is exactly holding them back? Let's talk about the unholy trinity in the world of economics. I believe the trilemma triangle will not be unfamiliar to most of you. Essentially, the theory says that a country cannot maintain a flexible monetary policy, a controlled exchange rate, and a freely flowing capital at the same time. It can only choose two out of the three. And this concept was popularized in the 1960s. So where do you think China is currently residing at? If you don't know, then I'll probably be quite disappointed in myself, because it just means that I suck at explaining concepts. But anyway, given the discussions of the historical progress of China, it is quite clear that they want exchange rate stability and they have a rather strong control on their monetary policy, which inevitably translates to a lack of market openness. For the longest time ever, many countries have been accusing China of manipulating their currency, but China is left with not much choices on the table anyway. We all know China is an export-driven country. Many would dub China as the world's factory. Even in 2020 alone, as other economies struggled with the effects of the pandemic, China's manufacturing output was $3.85 trillion, trillion with a T, accounting for a third of the global market. If your entire economy is reliant on export, what's the single most deadly thing that can happen to you? Yes, appreciation of your currency. Because majority of the goods and services China provides are denominated in their home currency, and if the currency do not stay low, imports from other countries' perspective would seem much more expensive, and they would rather find an alternative because Chinese exports are most probably easily substitutable because they are not very high up the value chain. We can also see that the renminbi exchange rate has been largely controlled within a specific band to ensure that they do not fluctuate wildly, which will be detrimental to the entire economy. That said, the renminbi exchange rate band has been widened over time, suggesting a much more flexible movement as compared to before. But the volatility has been limited in comparison to the volatility of other freely floating currencies, such as the euro, Japanese yen, or even the Australian dollar. So in 2017, in a closed-door meeting, Chairman Xi actually made it extremely clear that the government's mandate for 2017 was that he would tolerate no wobbliness in the entire economy. It speaks volume about his resolute and his intention. Let's be clear, the appreciation of renminbi to the US dollars can come in two forms. Either the renminbi appreciates or the USD depreciates, because it's always a currency pair and it works both ways. The sad thing is, if the USD depreciates, China has no choice but to depreciate to a larger extent in order to make their exports look more attractive, because the USD still holds the reserve currency status. Hence, China has always been accused of being a master manipulator. 2020 was an exceptional year though. Because of the pandemic, the entire global supply chain collapsed and experienced a massive disruption. Factories cannot open, workers cannot go to work, people are trapped at home. China's recovery, on the other hand, took the world by a surprise. Their quick economic recovery sent the renminbi soaring in the second half of 2020, bouncing back to a level not seen since before the US-China trade war started in 2018. The renminbi experienced a steady appreciation against the USD over the last 2 years. But wait, what about the entire export-oriented argument that we talked about just now? Didn't you just say an appreciation would harm the Chinese economy more than benefiting them? That's the thing. China exploited their position and knew that they were one of the most successful countries in controlling the pandemic by adopting a zero-tolerance policy against the pandemic. They had extremely strict quarantine rules, travel restrictions, and lockdowns of cities. This allowed them to bounce back really quickly and go back to business as per usual, while others are still struggling. And because companies do not have a suitable substitute due to the supply chain disruption, China can go easy on the exchange rate policy. The silver lining is, given that the USA is currently performing the greatest magic trick of all times, even better than David Copperfield by the way, by infinitely expanding their country's balance sheet and running the printing machine. In theory, the USD should be depreciating significantly because of the huge influx of supply. And if China is not in the position to set prices for their exports, they will have to depreciate to a larger extent to match the USD's movement in order to keep the prices of their exports competitive. However, China is not left in that state. Then again, I would like to say that this was really strategic on China's part. But people will start accusing me, saying that I'm part of 50 Cent's army, I'm a spy sent by the CCP. So I would just say that China is lucky. Can we agree on that? Now, to answer the biggest question every investor remotely interested in China wants to know, this upcoming crisis or recession or whatever you want to call it, surrounding Evergrande and the property market, what's going to happen? To give you the honest answer, I don't know. Remember at the start of this video regarding my short answer? Yes, it's manipulated. Some people will be dumbfounded. Who in the right mind, especially which government in the right mind, will want to inflict a recession on the country? Beats me. Maybe some of you can enlighten me. With this amount of sophistication and manipulation over the last decade, why do you think they cannot come out of this even stronger? The key idea of having the ability to manipulate your economy is that you can dictate when to allow it to grow and when you think you should draw the line and get everyone back on track. On the flip side, the core concept of a free market economy, allowing the manipulation of any external forces, both friendly and unfriendly, suggests that you allow for any forms of speculation to occur and any forms of bubble to consolidate. China's government is a control freak, so don't expect them to keep both eyes closed when they feel that any particular industry or markets are getting too warm. And as many people like to proclaim, China wants to control everything, right? I would believe that they have full control of the data, the performance of the country. If they know that the property market is running wild with huge amount of speculations going on, and they still decide to not do anything, then isn't it just irresponsible of the government? They adopt a vastly different mindset. They probably don't believe that the market will fix itself. At least, maybe they do, but it will take a long time and it's a tiresome process and many stakeholders will be hurt along the way. People immediately bounce back and say, hey, the equities market of all the Chinese tech stocks, edtech and property sector experienced more than a 50% haircut. Is that recession not big enough? My friend, the terminology of recession here is explained by having 2 consecutive quarters of economic decline, so a negative growth in GDP, in conjunction with indicators such as the rise in unemployment. Who cares about how your portfolio is doing? You think the CCP cares? They're running a country, not your portfolio. When a recession really hits, do you know how painful it is for the people that lost their jobs, when the outlook is gloomy, and when the expectation for their future are all gone? That's exactly the kind of BS the government is avoiding, so they would rather take it in their own hands before letting things get out of hand. Last but not least, the caveat of this entire discussion is contingent on the competency of the people in governance. If you have good people running the country, full autonomy and efficiency of the government will allow it to achieve great things. If you have lousy people in government, regardless of how good your system is, the country will still suffer. So you be your own judge. So leave in the comment section down below, when do you think China will go into a recession? With that, I'll see you in the next video, but more importantly, I'll see you on the moon. Goodbye!